Frequency Podcast Network. Stories that matter, podcasts that resonate.
So in other news, as the Toronto Blue Jays are making their way through the World Series, there have been a lot of developments in the world of economics and politics and earnings this week for the markets. We've had interest rate cuts at the Bank of Canada and the U.S. Federal Reserve, a bunch of big-name tech companies reporting earnings, a milestone week for NVIDIA, which became the world's first $5 trillion company after Apple joined the $4 trillion club this week, and record highs for benchmarks and all sorts of movements in currencies and commodities. To kind of go over what's been going on, as, again, the focus has been on the Jays, I get that. But I'm joined by Barry Schwartz, President and Chief Investment Officer at Baskin Wealth in Toronto. Welcome to In This Economy. Barry, how you doing?
I'm exhausted, Mike. How are you?
Me too. We all are. My voice is shot. We're staying up way too late. Some of us have to get up earlier than others. But yeah, we're fully invested, if you will, in the Jays' success. And we're recording this, and they're coming back home for game number 6, and we'll see how that goes.
I feel like I have 2 full-time jobs. Full-time baseball watcher and full-time investor. So
let's talk what's been going on this week on the markets. And I want to start actually with the interest rate policy announcements. Here in Canada, the BOC was cutting rates another 0.25%. Overnight lending rate down to 2.25%. I thought Tiff Macklem was really quite dour in his commentary about the state of the economy. He didn't really hold back about the impact of the trade war with the United States, saying it's structural now at this point against the Canadian economy. The outlook for 2026 isn't great. And the Bank of Canada saying, there's not much more that we can do. I mean, at a certain point, cutting interest rates isn't the solution to the problem. So what was your takeaway? Were you as I don't know, pessimistic as I was coming away from that?
Well, that's the only tool the Bank of Canada has is either to raise or lower interest rates. Clearly, they're lowering interest rates as they don't see inflation, which was a huge problem, as we know, in 21 and 2022 as an issue, or at least a majority issue. And the concern, of course, is you're absolutely right. The worries about the tariffs, the uncertainty about the economy right now. The fact of the matter is that the low and middle income consumer is really, really struggling. They're struggling with credit card payments, with car debt. We're seeing the worries about potential layoffs, huge layoffs, if AI really becomes a thing. You've already seen large announcements by a lot of companies in the United States, Amazon, UPS. And so it's not a really good outlook for the Canadian economy. And even though the U.S. economy seems to be on fire because of the crazy spending on AI, which is really boosting the U.S. economy, we don't seem to have, the same type of exposure here in Canada. We're very manufacturing centric, very resource based. Some of the resources are doing well, some of them aren't, right? Oil prices have come down a fair bit. Gold is great. So in our opinion, the Bank of Canada is going to do what it has to do, which is many more interest rates to come. They've used the word restrictive over the last couple of years. And even the United States has too. So interest rates are not at a level where it can really boost the economy. Maybe maybe that will be the case by the end of next year. But the inflation has done its damage. Whether or not it goes higher from here is anybody's guess. But the damage is done. Everybody knows going out to eat, picking up food, buying a new car. All these things have gone insane, and they're not going back to normal prices. And with the worry about job losses because of tariffs, as well as a transformation, we're having a weird thing going on, right? This economy is transforming before our eyes with AI, and we're still in its infancy. So I know it's theoretical at the moment, but every company's looking to adopt it. And the way to adopt it is to look to lower your costs. So that's where we are today. Obviously, we don't know the knock-on effects and who will benefit and who will lose as a result. But the Bank of Canada and U.S. Federal Reserve only has one choice, and that's to cut interest rates as long as inflation stays within their target range, and that seems to be the case at the moment.
Well, they weren't really saying, Macklem wasn't really saying anything about cutting rates again. And I mean, the market's not pricing anything in this year anymore. He kind of said indicated, hey, federal government, ball's in your court now with the budget next week.
Absolutely.
You got to do something.
Yeah. So there's two ways to stimulate the economy. Obviously, there's monetary and there's fiscal policy. So one way is you lower interest rates is try to stimulate business demand, consumer demand, more people taking on mortgages, more people starting businesses, more people investing. I mean, we also have Mark Carney has laid out a plan to really spend a significant amount of money on infrastructure. We're seeing the benefits of the spending on infrastructure in the United States. They're so ahead of the game. We sat on our hands for years and years, and this is the pain that we're suffering as a result. So I'm happy that Carney has a plan, and I think that's building these infrastructure projects, whether it's LNG, whether it's data centers, whether it's more pipelines. That's going to create jobs. That's going to create opportunities. That's going to lead to money flowing back into Canada, which is very necessarily needed. And at the same time, the interest rate policy will adjust according to how the economy is doing. But right now, it's hard to see any catalysts or surprises for the Canadian economy in the short term.
You mentioned about the Fed maybe cutting rates again. They did so 0.25%, and I thought Jay Powell's comments, the market was pricing in another rate cut on December 10th for the Fed. You can argue why, and within the discussion, the group discussion about the need to cut rates as opposed to not. He was basically saying, it's not a sure thing. They're data dependent. They're not getting any data right now, which is not another thing with the U.S. government. With the U.S. government shutdown, they're flying blind kind of thing. I also thought it was interesting that the market really didn't have much reaction to two things: Trump cutting off talks with Canada, and then Trump also signing getting this 1-year deal with China. It was early in the trade war. You mentioned Trump and trade, markets would move. Now we're not seeing that. Why do you think that is?
We're not seeing it because we know that Trump is using the taco plan, where he uses a lot of leverage and bluster and scare and threat tactics and gets what he wants. It's a whole bunch of nothing at the end of the day. And I get a lot of calls from clients and people asking, how in the world is the stock market doing so well with all this uncertainty and with the Trump flip-flopping? And the fact of the matter is, all you have to do is look at corporate earnings. I know you want to segue eventually to talk about the earnings of some of these companies, but oh my God, no one's talking about how unbelievable the earnings growth we've seen over the past few days from some of these businesses. Google, fantastic. I know Meta, its shares are down, but it reported revenue growth of 26%. This is a multi-trillion-dollar company growing at scale at these levels. So I think people are really missing the forest for the trees. There's a lot of great stuff going on for investors. Interest rates coming down, check mark, that's fabulous. Inflation tame for now, check mark, that's fabulous. Corporate earnings rising, check mark, that's fabulous. And the fact of the matter is, a fair amount of companies are not participating in this rally. So lots of opportunities if you look outside this AI theme. Okay,
let's talk about the earnings, because that raises other points. The fact that the market is so heavily concentrated. Earlier this week, I think, what was the statistics I saw? Something about the S&P had an up day when the market internals were like the worst in decades, where there were only 100 and some odd stocks up, but over 300 that were down, and yet all the S&P was up. And it just showed the outsized weight of NVIDIA and Apple and all these, the Mag 7. And that was kind of a red flag in and of itself. So and the other argument against the AI trend and saying it's a bubble or hearkening back to 2000 and such, is that it's circuitous, that OpenAI is investing and it all comes back to OpenAI and they feed upon themselves. But at the bottom line is, these earnings have been stellar. I mean, Google, you mentioned that, Alphabet, $100 billion in revenue for the first time ever.
I think people need to just, okay, let's tackle the concentration problem. The concentration problem is a problem. It's a great problem to have because you have these dominant global businesses. The S&P 500 essentially is a global index now. Forget that it's a United States index. The companies that dominate it generate most of the revenues outside the US and have billions and billions of customers. They deserve to trade at multi-trillion-dollar market caps. There's no question about it. And if you look at the valuations of some of these stocks, Google, Amazon, Apple, Microsoft, Meta, yes, those valuations are trading at the high end. However, the profits justify it. And we've never seen businesses like this ever before. So we have no context. We have no benchmark. When people say, well, the S&P 500 in my day traded at 15 times earnings. Okay, but the S&P 500, when it traded 15 times earnings in your day, did not have companies like we do today. It was dominated by banks, utilities, cyclicals, manufacturing companies who didn't have billions of customers with gigantic recurring revenue and the ability to sell more products and services to them at the drop of a hat as they write new code. So it's mind-boggling how tremendous these companies are. And the way to think about it is these are going to be the companies that dominate the world going forward. And if you think like I do, that we're going to be using more compute power in the future, not less, then they should be spending all their money building it now to get advantage and to build that competitive advantage versus any other competitor. That's what monopolies do. Monopolies need to grow at fast rates. They need to get into new areas to dominate and flex their balance sheet, and no one's going to catch these guys.
The big argument is, as you know, from the naysayers is, okay, what's the return on investment for putting all this money into AI? I guess it's got to pay. It's got to eventually generate the payback that, you know, is built into these earnings. No,
correct, and that's and that is what the market is wrestling with today. Meta came out with guidance that the capital expenditures, which are going to be an insane amount this year, $70 billion. Mind-boggling. They're saying it's going to grow even faster next year. So that already targets $100 billion plus on spending on God knows what. And so the market is rightly skeptical. You're spending $100 billion. We read that you're hiring all these AI talent, paying them hundreds of millions of dollars. Like, what the heck is going on? And Meta will say to you that we have the ability to increase our revenues by a dramatic amount if this works. How does Meta make money? Meta makes money when you click on an ad, right? You're doom scrolling or looking at reels for half an hour and you see something and you click on it. They believe that if they improve the technology with AI, with learning language models, that you'll be more likely to click through the ad. And if that works, they could double their revenues in a very short period of time. So this is what it's all about. This is why they're spending the big bucks. People have doubted these companies for probably decades now, and all they've done is had a clear pathway to monetization of pretty much everything they've done. When you won't remember this, I barely remember this, but you know, people were pooping on Google's cloud investment. They're never going to make any money. They're losing money. They're burning cash. Now, all of a sudden, it's generating gigantic profits. You just have to be patient. We don't understand how much data is being used, how much compute power is needed. And if you believe that we're going to have robots and self-driving cars and AI agents, we don't even have anywhere near the amount of compute power today to satisfy that.
And also, Meta also has a tendency to pivot if necessary. I mean, Zuckerberg was all big on the metaverse. That was that flamed out pretty quick, and they just said, okay, we'll do something else. Because again, the pockets, these companies, compare and contrast to the dot-com bubble, those companies, I would argue, were fake. They had no, imaginary revenue stream, no profitability whatsoever. All of these companies we're talking about in this AI run-up, like you say, they're making just gobs of money.
What's making the market a little bit nervous is initially most of these companies were covering it with existing free cash flow, right? So, okay, they're blowing their brains out in AI, but at least they're not raising money. They're not issuing new stock to cover it. That was the silliness that we saw in the .com, right? But now we're seeing Meta and Oracle having to raise money for their ambitions. And so we really need to see a return on investment for these companies. And in the meantime, you have these multi-trillion-dollar companies growing at double-digit rates, top-line revenue growth. That's insane, right? When you're already doing $100 billion of revenue to grow next year by 20%. It doesn't compute with anybody, but this is what they're all fighting for. So it's pretty exciting, and AI it's hard to wrap your mind around it, but you are seeing the benefits in the bottom line profits. I mean, look at Google, tremendous earnings results.
And I guess the other thing that's reminiscent, and I hate harping back to that, but when Oracle goes up by 35% in a day, things like that, you kind of go, okay, either somebody really underestimated something, or that's the FOMO trade. Yeah, and it's just piling in momentum and not based on big projections, and we'll see if that actually works out.
And that's what the market does. This is nothing new. We all remember it, when we couldn't even get through to the discount brokers years ago because everybody was buying cannabis stocks. I would urge any investor to, if you want to have a piece of it, don't blow your brains out, because bad stuff always happens. Bet on the big techs instead of betting on some kind of nebulous type company that you don't even understand what it does and has no revenues, because at some point this will crack and the stalwarts, the blue chips, will perform. If you recall, in 2000, everybody thought if you didn't own the .coms, you were a moron. And we had clients telling us, you don't know what you're doing. You've lost your touch. Why are you investing me in these boring blue chips? Can't we be buying Nortel, JDS Uniphase, Pets.com, BS.com? Buy it for me. And we said, no, there's no fundamentals. There's no way to value these companies. There's no cash flows. And this is very reminiscent of that period, except that there are some companies that are just making a ton of money. As you said, there's nowhere near a bubble. But we're always going to have elements of speculation in the market, and you don't need to participate in it. So you don't need to worry about it, because at some point it is going to blow up.
Yeah, well, you raised a good point there about getting through to a broker or what have you. I mean, you can trade online. Is it so prevalent and easy to get in to the market that day traders are amplifying things? Would that be a good assessment, because money moves a lot faster than it used to?
Well, it's not just day traders. You have these
retail trade in general.
Yeah, well, we have these algorithmic trading houses, companies that that are extremely private, like Jane Street and Renaissance Technologies, and many others that manage multi-billions of money and trade in multi-billion dollars of trades every single day, moving the most liquid stocks that they can. And so everybody's playing a different game in investing. You don't have to worry about if you're a long-term investor, don't worry about what the day traders are doing. They're just playing the momentum. If it's going down, they're going to push it down more. When it's going up, they're going to push it up more. That has nothing to do with investing. That's pure gambling. That's pure speculation. This is pure casino stuff. And they're using algorithmic trading and AI technology, and they've created models that you and I don't understand and don't have access to. So that's not something that you need to be concerned with. And use it to your advantage, right? If you think that Meta, who reported 26% revenue growth, stunning earnings growth, adjusting for the one-time tax, if you think the stock is worth 13% less, then you haven't done your homework, and you're listening to the market. So there's no need to listen to the market. Use it to your advantage. And, we've been seeing an enormous amount of volatility. As you said, Oracle up 35% one day, stocks up and down 15%, like it's nothing. That's just a function of how much liquidity that there is in the markets, and that's really actually a good thing. I want liquidity. I want to be able to tell my clients, okay, if you don't like it, this stock, we can get out, we can cash out for you. We have no troubles. Liquidity is the greatest thing in the world. It means you can have access to your money. There's lots of investments and products where people don't have access to their money, and they're stuck in there for years and years and years. So whether you like the stock market or you hate the stock market, it's the only game in town for liquidity.
I do want to leave it though on this point that I'm looking at the performance this year. Best performing index is Toronto.
Wow.
It's again, if you're just in an index fund and you're buying Canada, you're not doing too bad. 24% so far.
Yeah, most wealth managers like Baskin are not anywhere near those returns this year. Gold, for all its faults, has been just a tremendous mover this year, and many of the gold stocks are up 100, 200, 300%.
It's been concentrated. I'll grant you that.
Yeah, and the TSX has the highest exposure of any index to gold, so that's working. And then you've got some just terrific movers that like Celestica, out of nowhere.
Celestica was dead money.
It's a $10 stock.
For how many years? I saw that this week, and I'm like, I've been watching it all year, but I'm like, oh my gosh, we talked about Celestica doing nothing for so many years, and now look at it, it's almost $500.
Unbelievable. They've pivoted their business. They used to be a contract manufacturer, just assembling stuff for technology companies. It still kind of has that origins, but obviously pivoted to AI, and it's been a tremendous run. Shopify, unbelievable. So you have these elements of speculation. Those two companies are trading at valuations that are hard to justify. They're eye-popping. The growth has been tremendous. At some point, the growth has to slow like every other business, and since the beginning of time. But the bottom line is it's been a really weird market in Canada. Financials are doing great. You have companies like Power Corp that are up big, and the banks. So I think a lot of the market has gone ahead of itself. You should not be investing in frothy areas. Anything that's trading at huge valuations without justifying the growth, you need to take a second look and tell your advisor, or take a look and trim some of this. I wouldn't say that the TSX index is a good index to own long term because of its concentration, because of it doesn't really have exposure to all the right sectors. But in any one year, random performance can happen, and you can look like a genius or an idiot.
Anybody who bet big on the Blue Jays at the start of the year, they're making pretty big money.
Well, my dad's friend has bet $5,000 that the Blue Jays are going to win the World Series. So,
wow,
I'm hopeful that that works out for you.
There you go. Leave it there. Thanks, Barry. Good talking to you.
Thanks for having me. Anytime. We'll talk soon.
That was Barry Schwartz, President and Chief Investment Officer at Baskin Wealth in Toronto. My name is Mike Eppel. If you've enjoyed this episode, hey, share it with your friends. Tell others. And if you want to send any feedback or what have you, you can send me an email at mike.eppel, E-P-P-E-L, at rci.rogers.com. On social media, Twitter, @al. I am on @Eppman, E-P-P-M-A-N. Thanks for listening. We'll talk soon.